Greetings, everyone. This is Wealth Wednesday, and our special guest is Yvonne Bubienko, which is a senior mortgage officer with Metro Brokers Financial, which is our preferred lender with Better Homes and Gardens, Real Estate Metro Brokers. And our first part of the conversation is, what do you look for when you're looking for a lender? Please give us that answer. We need it.
And then, okay. So the first thing that I would say is I would want someone to have given themselves enough time, especially if they lack the knowledge on how we kind of do the whole real estate pre-qualification, so they could do that. The second piece of the puzzle that I think is a lot of realtors, and this is probably just humans overall, have a tendency, especially when they're newer into the field, is being sold by something shiny. So a loan officer comes along and say, you know what, I could do all these crazy stuff. And you sort of think like, well, that's the person I should send my business to. And I've always have had the mentality personally as a loan officer is I want to be in the room full of people, the least educated one, because if I am the one that is the smartest, then if something happens, we are in trouble because there's no one else to help. And oftentimes that loan officer that is the something shiny that sells you, the dream boat, doesn't have the time, the capacity, or the willingness to really talk to a lot of first-time home buyers to say, okay, this is how we pre-qualified. You are not ready because of X, Y, and Z. Here's what we need to work on, and actually set up calls and set up steps for that person to continually grow, that being credit, that being savings, that being job stability, whatever might it be. But I think very often someone goes to maybe Federal Bank of America, Chase, whomever they're banking with, gets just a quick no without any explanation. And I think that's what's very disheartening to a lot of first-time home buyers.
Yes, yes. Yeah, I have to piggyback on that is that you already have some type of fear of going in and trying to get the loan if you know that you don't know what you need, right? And then to, like you said, just get a no and somebody not work with you and explain these are the things that you're missing or these are the things that you're going to work on so that you can qualify. And I think that's important. And that's also one of the reasons why I wanted you to speak is because I saw that in you that you're trying to really help the clients. It's not just let me make this sale, let me get them into this loan. And I think that's important. So there are several different loan options, right? And so some of the ones that we talk about are the FHA, VA, USDA, and of course there are first-time home buyers programs. Who is typically the best candidate for an FHA loan?
So let me correct you on something.
Okay.
First-time homebuyer programs are not different programs. They are still conventional or FHA loans.
Got you.
They just simply have different requirements that are oftentimes are less restrictive than a subsequent home buyer because that person who's buying is a first-time home buyer. That is the only difference. It's still an FHA loan. It's still a conventional loan. It's still the base of the loan is the same, but the requirement to either have a lower down payment or perhaps a better interest rate is going to be then based if that person is in fact purchasing a house for the first time.
Got you. And this is why I have to lean on the experts. So what are some of the advantages of the FHA loans?
Absolutely. I think whenever we get phone calls about first-time home buyers, people naturally sort of come in with this information that they heard from someone else or read, okay, I'm a first-time home buyer, this is what I want. First-time home buyer loan, like a true first-time home buyer loan, is one of the two that I will mention. One of them is a conventional loan that allows a lower down payment than a traditional minimum 5%, and that is 3%. The issue with a conventional loan for most first-time home buyers is the credit requirement, although not on paper, but in real life scenario, tends to be more restrictive than a first-time home buyer generally has. So when you're putting down as little as 3%, most of the underwriting system is essentially spitting that loan back at you if you don't have a 700 plus credit score. So for most first-time home buyers, that's just not what they have. But that is an option, and that is a true conventional first-time home buyer. Then the second option is an FHA loan. FHA loan has a lower credit requirement, which goes down as little as 580, but still a low down payment, which is 3.5%. And most first-time home buyers will fit into that box a lot easier. And because that product is insured by FHA, Federal Housing Administration, it physically lowers a monthly interest rate because of the money behind it. That also allows greater flexibility of how much someone qualifies for. Because if you qualify for something, but the rate is 8%, that's not really helping you, because you already might have a tight budget. FHA has a low down payment and low interest rate. So it tends to attract, and it's the easiest loan for us to qualify someone who's a first-time home buyer.
Wow. Okay, that definitely cleared up some things that I had questions about. So I guess my next question is, the first step somebody does, what would you advise? Do they come to the loan officer first? So I'm asking these questions as somebody who does not, know these things. If I
Sure.
said I wanted to, I want a
Buy a
home.
house.
Yeah.
Of course. Yeah.
What is some of the
So
first things?
the
Or
mortgage
the first
industry for
person,
the
I'm
last
sorry.
30 years, the mortgage industry for the last 30 years is made out of three pillars:
Mhm.
your credit, your employment, and the money that you bring into the table. Okay. So the first thing you want to know is those three things. What do you need? You're looking for a house that is a certain neighborhood or a certain size, and that house that is 4 bedroom plus tends to be, let's just say, 350,000. Sometimes you need to work forward, sometimes you need to work backwards. So sometimes I'll talk to someone and they'll say, I'm looking for a 4 bedroom house in Fayetteville. I'm like, okay, great. What are the houses in that area selling for when they're that size? And somebody will say, well, 350,000. I'm like, okay, great. So this is what you would need as a down payment, 3.5% of 350,000. That immediately makes someone sit down and say, okay, is that in my budget? Right. So that's just, we haven't done anything. We haven't scared them. We haven't had credit check and any hard conversations. We're just talking math, because
Right.
sometimes people don't know math and they're afraid to ask.
Right.
And they're looking at Zillow, and Zillow unfortunately always assumes that a buyer has 20% down and a 720 credit score when they're listing the monthly payment. And that's very misleading. If you don't know how to read it, where to look for it, you literally are going, this is not making sense. What the loan officer is telling me, or what I see houses are monthly payment listed for. So the first thing that I do when I talk to somebody is just talk to them. Just literally say, like, what are your concerns? Is it job instability? Is it the amount of money for the down payment that you're concerned about? Is it your credit? And whatever it is, I try to kind of take the Band-Aid off.
Right.
It's sort of like trying to lose weight. You're going to have to get on the scale.
Yeah.
It doesn't change anything. It just gives you a starting point. So when we do, and usually it's the credit, when we do the credit, what I'm looking for is, what can we fix with time or small corrections that are going to feel doable, but will progressively be improving. Psychologically speaking, all of us as human beings, buying a house or trying to run a 5K, you want to see progression of success. Otherwise, it's very defeating and negative kind of self-talk that people have. So if you're coming to the loan officer, I personally just talk to people. I'm like, what can I help you with? Tell me what questions you have. And then usually, as a loan officer, it's almost funny, because for me to ask someone how much they make, what they have in the savings account, it's literally like asking, like, what's your favorite nail polish? I do it so naturally that it doesn't scare people. It's just kind of like just numbers. I'm just writing down numbers. So that's the easy part. But I think for most people, the hard part is, how does it work? How do I get pre-qualified? Like, how is the magic behind it? And how do I do anything about my credit? Those two things feel very inaccessible to people. And I try to do an explanation of how we qualify someone by utilizing simple math. And then I really, really encourage them to let me pull credit and let's talk about what's on it, what I see, what I think they could do to really make substantial changes. And personally, as a loan officer, then I set up a follow-up call. So then there is a responsibility to respond. Does everybody show up for follow-up call? No. But someone who really wants to buy a house, yes, they actually do.
Right.
And it feels kind of more like in bites that they could chew, process, get success, and move on.
Yes, yes. That makes perfect sense. I do want to, you mentioned the 20%, right? So I guess I have a two-part. What is kind of I know it changes based on people, but what is like that average that most people put down? And then why is that the first thing that people assume is that they have to pay 20% of the home purchase?
Because until probably the 80s, that was the minimum down payment.
Gotcha.
So the
Yep.
20% became the norm.
Yeah.
Like that's what everybody was doing.
Mhm.
Then companies came through that were allowing mortgage insurance. And mortgage insurance then allows the lender to have a lower down payment from the buyer because the buyer is paying a monthly mortgage insurance that protects that lender. So whenever you have 20% down, you no longer have mortgage insurance. The idea is the lender is saying, if you buy a house for $300,000, you are unlikely to walk away from $60,000 that you put down in cash on this property. However, if you're only putting down, say, 5%, right? That's 15,000. Then there is a possibility if the wheels come off the bus, proverbially speaking, financially, you're going to say, I just can't do this. So the monthly insurance that you've been paying covers that for the lender, that gap that they potentially could lose. So that's, relatively speaking, a newer thing than something that's been around, since the 40s kind of a thing. So that's the reason people assume the 20% is the minimum, because it used to be. And of course, you hear the David Ramseys, the Clark Howard of the world talking about it, but they're talking to an unrealistic world. Most people purchasing a house who are buying, let's face it, the average house now probably is around 300,000.
Mm-hmm.
Most people don't have 60K just laying around in their checking and savings account.
Mm-hmm.
Okay. All right.
I
Okay.
have a question real quick.
Yes.
Yvonne, did you speak to, I know FHA, you have your PMI for the life of the loan.
Mhm.
For conventional, you may start out with a PMI, but it drops off after you've paid into 80% of, well, there's the 80 LTV?
80% loan to value. Yep.
Yeah. So that's good to know because, some people aren't.
Well, I mean, yes, but I think because we are in real estate, so I think for us that makes immediate sense. We want to know more. I think it's overwhelming to a first-time home buyer. So
Right.
I would say to your point, to add to this, FHA has an upfront mortgage insurance of 1.75% that's added to the balance of the loan, and it carries a monthly mortgage insurance that is fixed, meaning that it's not reliant on credit score. It's not underwriting the borrower. It just has a fixed percent that is attached to the loan based on the loan size. If you put down 10% upfront on an FHA loan, the monthly mortgage insurance after 120 payments, which is 10 years, will also automatically go away on an FHA loan. But if you put anything less than 10% on an FHA loan, it will never go away. You will have to actually refinance out of that loan. Conventional loans, on the other hand, don't have an upfront fee, but they have a monthly fee. However, that fee is based on two items. Item one being your credit, item two being your debt to income ratio. So there's a tipping point on a conventional loan that you might have a borrower that's, let's say, 690 credit score. Sort of like somebody I could take FHA maybe, but gosh, I got them approved conventional. This may be a better deal for them. But the mortgage insurance, because they may be very high on their debt to income ratio and over 45%, may be actually higher than it would be on an FHA loan. So sometimes you literally have to price out both options, explain both options, and then let the buyer decide.
Okay, that makes perfect sense. Thank you for that. And thank you for the questions, Kimberly.
I'm like, it's a lot of information.
Yeah, it is. So I want to go into another program or another loan option, which is the VA. Who qualifies and what are some of the available benefits for a veteran that's doing VA financing?
Absolutely. So VA loans obviously available for veterans. There's some weird VA rules. You're only allowed to be on the loan with a spouse unless you're putting down, I think, 5 or 10%, and I don't recall the down payment. You could then have a fiance, but VA is very particular. They want the veteran and their spouse to be sort of the only ones having access to it. But it's a wonderful product because it allows 100% financing. It has a funding fee, although for many veterans who have any disabilities that are related to their service, that fee is waived and there is no monthly mortgage insurance. So it gives you the opportunity of going into a house with the least out of pocket with a very, very aggressive interest rate and no monthly mortgage insurance. So really, sort of really giving back in the true sense of the word, a product that doesn't have any gotchas. There's no weird, if you do this, then this happens. It's a fantastic product. I think completely underutilized. One of the things that I think a lot of people forget is you could use it multiple times. Mm-hmm. Oftentimes people think it's a one and done. You know, we're going to wait until we get the house of a dream to utilize our VA benefits. You are able to continually use it. Buy a house, sell that house, reestablish your eligibility, purchase another one. I see sometimes people actually having enough eligibility to have two houses simultaneously. Sometimes work moves you and you have to have your departing residence become a rental property, and your new residence is still potentially able to be covered by VA benefits. And same rate, nothing, there's no gotchas on either one.
That was.
I'm sorry. There's some misconception though with some people who think that because they have a VA loan that, you know, their credit can be any kind of way. And I tell people, just because you have your VA entitlement does not mean you can come get a loan for 400 or 500 with a 400 or 500 credit score. Isn't that
VA on the guidelines? I think the misconception exists because if you were to read VA guidelines, VA actually doesn't state a minimum credit score requirement. Mm-hmm. Lenders impose a minimum credit score requirement because the only thing that VA is doing is actually insuring the loan.
For sure.
The lender is doing the loan. The VA is insuring the loan.
Yeah.
So VA guidelines just don't have a credit score requirement, and that's probably where the misconception lies.
That's probably it. That's it right there, Yvonne. Thank you.
Yep.
So what is something veterans may not realize about their VA loan benefits?
I mean, I think that,
and that was one of them that you just mentioned.
Yeah, I think that's really the one that I could think of. Or if they have, I had an instance where I had a gentleman who had a condominium in Columbus, Georgia, and then was offered a job at Coca-Cola. Obviously not a doable drive.
Right.
But he had enough of VA benefits that he was able to purchase a single family residence in Stockbridge for like $270,000 with the remaining benefits, and then make his condo become a rental property. And that was something that he didn't know, because I think there is a misconception of just having a singular ownership. And sometimes that is in fact the case, that you have a large home that has used up your eligibility and you don't have the ability of getting another house while the other house is still under your name. Right. The other misconception that I will say kind of in reverse is VA loans, like FHA loans, are assumable, which means you are allowing to take the terms and conditions that you are qualified. Let's just say you purchase a house as a veteran during COVID at a rate of 3%. And someone comes along and wants to say, I would like to have that rate. So you're able to transfer literally all of the terms and conditions that you got to the new person. But VA doesn't allow your eligibility to be freed up because it requires the house to be sold.
Got you.
So sometimes people will say, well, I sold that house. No, someone assumed the terms and conditions that you had, and none of the benefits of the VA eligibility were released back to you because VA is still insuring that property.
Okay. Valuable information. You mentioned a couple things that I didn't know. I was not aware that they couldn't purchase. I mean, that they could purchase more than one time. I did think it was a one and done. So that's definitely information
Lots
for
of people
me.
do. Yeah. Lots of people do.
I do want to go back because we added in PMI, even though we're realtors and we know what that means. Can you kind of give us what that means and a little bit about that, just because we did mention it?
Yep. So anytime you're putting down less than 20% on any sort of a loan, that being owner-occupied investment, second home, the mortgage industry requires that you carry private mortgage insurance because, again, the risk to them exceeds what they're comfortable with. So private mortgage insurance is put on conventional loans because those loans are not federally backed, while government loans, so VA, FHA, USDA. VA insures VA loans, USDA loans, and then FHA loans. They have a fixed formula. VA doesn't have a monthly insurance; they just have a funding fee. USDA has a fee as well, and then FHA has an upfront fee and a monthly mortgage insurance, but that is fixed, so it's not based on credit worthiness or risk worthiness of the borrower. It is just a flat fee across the board.
Thank you.
I have a question.
Christina had her hand up. Go ahead.
Yeah, it's like the USDA loan, because I live in, I can say, rural Georgia. So like when it comes to the USDA loan, like how far from the cities, do you have to be to qualify, or what area do they consider to be rural?
Doesn't work that way.
I
wish it worked that way.
We were actually about to ask those same questions.
Yeah, it's almost like a corn maze, like you get in and you're like, whoo. I think it was like 1918. I remember once studying for a test in the mortgage industry, and I read a little bit of a history, but it was literally sort of at the peak of Industrial Revolution. There was this surge of people moving in to the city and abandoning rural America. So plots of land that were existing plots of land were established as USDA eligible plots of lands. I have had properties in new subdivision where 2 lots out of an entire subdivision were USDA approved and no one else was. So it's pre-established lots. It tends to be in areas where there is less than 25,000 residential households. That's sort of the only commonality that I see. But otherwise, it's literally per property. I had a new construction USDA loan because that specific lot happened to be in 1920 something approved as USDA property, and then another one down the street and nothing else. So you could literally have 101 Main Street approved and 103 Main Street not approved.
Wow. Now with the USDA loans, do they have a credit score requirement as well, like the other loans?
Most of them do. I believe is 620.
Okay.
Yeah. And USDA has some funny guidelines you want to kind of be aware of. So there's an income limit that it has, and it's for the whole family, even if the family's not on the mortgage, even if it's your kid selling some baseball cards on eBay, they will find it. And not being funny, I had once a loan declined over, I think, $1.68 over income per month. It is very black and white, because otherwise $1.68 for one person is $100 for another person. So it kind of cuts off. And second rule that's kind of weird that people always miss on is you cannot have more than $25,000 in assets. Because again, that loan is very much so made for a buyer who needs to have that kind of a loan. So if you are selling a house and you're coming in and you just don't want to use the equity that you've earned, no go, because those assets they will find, and you can't do that. So it has nothing to do with just the individual in the loan, the way we normally just qualify the individual. It's everyone that's going to be living in that household.
Oh, that is very valuable. Yes, very valuable information.
And how they find this information, guys, I don't even know. But literally, they will come back and they'll say, like, we see. Because now, like, eBay takes your social security when you sell something, they'll find everything.
Oh, wow.
Yeah.
Oh,
yeah.
Oh, wow.
It's the government.
Yeah. Can USDA loans really offer 0 down payment options?
Yes. And USDA loans allow another little trick. If the value of the property, and I can't remember the guidelines from the top of my head, but I believe it's 3%. So let's just say you're buying a house for $200,000 and and the house appraises for $206,000, which is additional 3% over asking price. You are able to use that additional 3% towards your closing cost.
Okay. Oh.
That doesn't affect the seller. It's not being anything that the seller has to provide, because normally they'll be coming from the seller. So this is just from the value. You're able to borrow above the asking price.
Got you. Okay, so we'll switch over to first-time home buyers.
Okay.
What programs are available for first-time home buyers?
So we talked about the conventional loan that has the 3% down. I'm going to tell you like how I feel as a loan officer about it, just because I think selling it is easy. I could tell you a story about every loan and make it sound great, but there is a downfall. What I see, I guess, as a loan officer is when those first-time home buyers that were sold these loans are coming to refinance or coming to sell, and they can't. And the reason behind it. So a conventional loan with 3% down, here's the good. It's a conventional loan. It has monthly MI, but not a fee for the MI the way FHA does. It has the ability of having the MI go away on its own without having to pay to refinance. It's more likely of a contract to be accepted by the seller because the seller thinks a conventional buyer, they must have good credit or, strong buyer. Like psychologically, a listing agencies, a conventional offer, they're going to say, I like it, versus FHA 100%. This could go either way, right? So the positive of conventional loan is I think it's more likely to be taken seriously by the listing agent and the seller. It has the ability of dropping mortgage insurance. The negative is it only allows 3% seller concession. So the 3% seller concession usually is not enough to cover closing costs. And first-time home buyers usually struggle with the closing cost. So if you have, let's just say, a $290,000 or $300,000 house, and your closing costs are, let's just say, $10K. You putting down 3%, that's $9,000. If you have to bring closing cost of $10,000, all of a sudden you bring $19,000. That's really scary for first-time home buyer, even if they have it, because that's really liquidating everything that they've worked so hard to save. So conventional loans would allow the seller to contribute 3% towards the closing cost. So technically cover most of it, right? But as you go into situations where the buyer really doesn't have anything beyond the 9,000, that conventional loan becomes really no longer a viable option, because if we use everything that the buyer has, reserves, which is money left over after the transaction, the underwriter says, this person is young, they have an okay job stability, credit is sort of borderline. I hate to leave them in a position where the toilet leaks and they have no way of paying the plumber. I mean, all of us would be when making, the reason we still go to a human underwriter is because that person has to think those things through, right? So reserve always change the stability of the loan. So although it exists, I rarely put a first-time home buyer on a conventional loan, just being honest. When we go over the options and all of that, conventional loans also tend to have a slightly higher interest rate. When I say slightly higher, depending on the market, sometimes it's as little as 3/8, sometimes it's as much as 3/4. So the interest rate on the conventional loan is, again, higher. That mortgage insurance is based on the credit score. So the mortgage insurance could be higher. So it's kind of like, how good is your credit as a first-time home buyer? 8 out of 10 times, it's not going to be great just because you're new to the game. So we price it out, but it's an option that I usually put it as my secondary option. Mm-hmm. And I personally always bring up FHA. My first loan before being in the mortgage industry was an FHA loan. 3 reasons, really. Reason number 1, credit score allowance. It goes down to 580. So once we get you up to that number, we have the ability of trying to get you approved. 580 is, for most buyers, an attainable number. Interest is substantially lower. Whatever conventional loans are doing, FHA is always lower. So you have now a lower monthly payment because the interest rate dictates the payment. Although you have monthly mortgage insurance that's added to the loan, the monthly mortgage insurance, it's not based on your credit score. So if you happen to be a buyer that is sort of on borderline when it comes to quality of credit, overall payment on an FHA loan is going to be lower. The most important thing, though, for me, is FHA allows 6% seller concession. So if the closing costs are $14,000 because taxes and insurance are higher for that specific house, that buyer would have to bring the down payment. Let's say the down payment was 10%, and 10,000 and 14,000 in closing costs. For most people, it's a no-go. Having the ability of having a buyer to only worry about the down payment because the seller legally could cover the entire thing is life-changing.
Yes.
I have a buyer right now that I'm closing on the 30th that just started a job. And for them, they scraped every penny for the down payment, but closing costs were the reason we went FHA. 773 credit score. FHA was still the better option. First-time home buyer, they just lacked the ability to save that much for both closing cost and down payment.
Got you. So I think one of the other big things is, how do you, for a person who's looking and might have some fear of all of the things to buy a house, what are some things that they should look for in a loan officer? Because I know I've heard great things about you. You'll sit down with people and things like that, but kind of on that realm of explanation and understanding, what should they be kind of looking for?
So the first thing, if the loan officer is being recommended by the agent, I would ask, then let's just say you are my agent and you're recommending someone. I would say, April, how many deals have you done with this person? Would be my first question. Did they all close on time? What was the feedback from your buyers? Do you ask feedback from your buyers? This is going to be controversial, but I'm a New Yorker, so I'm not afraid.
Hey, let's go.
I think too many people do loans and send business to other people who they know because their kids go to the same school. They go to the same church. Their neighbor's cousin know each other, versus does that person actually work like I do? Right? So if you are working your tail off, but then you give the borrower to someone who's going to work vastly differently than you do, and you never really get a true feedback from that buyer and ask questions and be sort of the in-between person, then what are you basing that continual referral of that person and the next person? Nothing, right? I think there's a responsibility for all of us to say, how consistent is the closing, the feedback from the buyers? So I would ask those questions as a buyer. And then if I spoke to the loan officer, I would literally just say, listen, this is my first time doing this home purchase thing. I want you to talk to me like I'm a 3-year-old, and I don't want you to use mortgage words. And everyone who knows this business well should be able to explain it without using mortgage words. Because it will be like someone explaining the stock market, but using the terms dividends and, whatever it is. And at a place where you just sitting there going like, what the heck is a dividend? And what's a mortgage-backed security? And what's secondary market is which part? No, don't use those words. If I don't know those words, then I'm going to feel perhaps uncomfortable asking, hey, you completely lost me. And a lot of people do. And a lot of people will say, I got declined. Why? I don't know. What did you ask? Well, no. Are you kidding me?
Yeah, I need to know why.
You need to know. You need to know to fix it, and you need to know. So sometimes it's incorrect. Sometimes someone says, you had a job gap for the last 24 months, you had 6 months of gap in your job and we can't do this. And you're like, no, wait a minute. I forgot to give you a W-2 for this. Like, you need to ask. Sometimes someone makes a mistake, but too often people will just use someone because they're banking at whatever name the institution. And that person is unresponsive and all these things, and they think that's just normal. No, it's not. We all work on commission. We are all doing this to build our business. So if I don't call you back, something is terribly wrong. Either something has happened to me, or I am not a person that you should be working with, unless you're okay with people not calling you back. But I'm not. Like, somebody doesn't call me back, I notify, I'm like, hey, I reached out to this attorney, they haven't called me back. I'm not sure. Let's touch base. We have the wrong email. Like, this is a business of, you got to get on it and you got to respond. So I don't think enough borrowers ask the realtor, why are you recommending this person? How many transactions? And once they get to that person, asking more questions.
Yes. So to your point, we work together, right, through this transaction to a certain extent. But I want you to kind of explain how you work with realtors in their clients in the process of, getting a loan, communication, things like that.
So obviously in our industry, there's a very specific division of responsibilities, and a lot of information simply cannot be shared. So it's not like you could just pick up the phone and just give the realtor the lowdown and vice versa, right? A lot of things is like, I could only say this and I have to ask permission. So generally speaking, obviously the laws have changed recently for those that are newer, but you have to now do an introduction as a realtor, because realtors were being sued by borrowers that said, hey, somebody's just randomly calling me. I don't know who this is. So the introduction happens. And at least personally, I, as a loan officer, then when I speak to that buyer, will then do a follow-up call or email or something to say, I can't do this because X, Y, and Z is missing. And I gave them what they need to do to get us to the place where we could do the next phone call, or report back. I did the pre-qual, it's coming your way. This is how much they could afford, whatever that is. If you go under contract, then personally, I will send out an email of, I've done this, this, and this. And for me, it's always going to be when I disclose the loan. So that's my sort of initial, I got the permission of everybody on the team to be able to move forward. When I order the appraisal and title, so then everybody's aware of our timeline, and those things have sort of started on their clock. And then when the loan gets out of underwriting, I will generally say, like, I have conditions, all the conditions are doable, all the conditions that I got and I'm expecting to get, I already spoke to the buyer. So it's touch points, but the buyer is always very much in the loop. So I will communicate everything that I need to with the buyer. They have the permission to obviously speak to you and communicate whatever, but I will let you know of the milestones of submitting the loan, ordering appraisal and title, getting the loan out of underwriting. And then if anything comes back, that's an issue. Because at that point, the window between, like yesterday, I got an email and it went to all the realtors and they said, hey, you submitted a loan, and in 8 days it became clear to close. So everybody's just kind of on board, like, hey, we got it. We already done, just waiting for it to close. But during those 8 days, the real estate agent that represents the buyer had updates from me when I ordered all those things. That's just how I work. But there are lots of real estate agents that will say, I don't need all of that. If there's an issue, let me know.
Right.
And that's legit, right? Like, you have to go with how someone works. My recommendation, just from my seat, that I always recommend, pick people who work harder than you for every aspect of this transaction. So then you know it's in good hands.
That's some good advice. You want to make sure that they're going to work and they're going to do their part. So you mentioned
more than you work on your deal. Like, you want somebody to carry your deal even more importantly than you are carrying it.
Right. Yes. That makes me feel good, and like you said, for a buyer, those are the kind of things that help motivate that connection, and they feel more comfortable. And then they're able to give you, sometimes they don't give everything, you know what I mean? But when they feel comfortable, it's like, this person is really trying to help me. So I think that's a good thing. But as you said, as some of us on the call are realtors, and, yourself building a business, right? So I think there's a lot of 1099 or self-employed, people, especially here in Georgia. And so they have a lot of questions and misunderstandings about what is required and what is needed. And so I kind of wanted to talk about that, as far as, the question would be, can self-employed individuals qualify for a mortgage? And then how does that look?
Sure, absolutely. So you could actually do just a very traditional way. Whenever someone gets pre-qualified for a loan, it always starts the same way. However they get paid is irrelevant initially, because what we're looking for is, what do you claim and pay taxes on to the IRS?
Right.
That being W-2 or 1099 or however you got there, is what you are paying taxes on sufficient for you to purchase a house? So let's say you are a self-employed person, you run a business and you make $120,000. You take no deductions, you just pay taxes on that $120,000. You could do any loan you could do any loan irrelevant of how much taxes you pay, as long as what is the number that you're paying taxes on sufficient for you to qualify. So let's take the 120 as our example. You didn't write off anything, you paid $20-some thousand that year for taxes, and next year you make the same, you pay the same. So in my world, when I see someone who's self-employed coming in, obviously I'm going to ask for the tax returns. I'm going to average that income that they claim as the final income that they're paying taxes on as the income for qualifying purposes. So if it's 120,000 each year, then it's 10,000 per month. 120 divided by 12 is 10K. This has been the way we've qualified people since I remember. So I literally could speak for it for the last 30 years. We then take that income before taxes, and that's our 100% income. So when we talk about the debt to income ratio, what we mean is, generally speaking, and this is just an easy guideline to remember, there are some variances, but they're so tiny that it's really irrelevant. No more than 50% of that 10,000 could go towards all of your expenses, including the house that you're looking to buy. So if you're making $10,000, 5,000 is 50%. Into that 5,000, everything on your credit report and the house you're looking to buy has to fit. You could have a 720 credit score, 840, or 602. There is no exceptions made. That is where the buck stops. Okay, that 50%. So when you are self-employed, very often what happens is you bring in a box of receipts to your CPA and you essentially say, write off everything that's legal. So your CPA is going to write off your car, your miles that you put on your car driving, your cell phone because you use it for work, perhaps meals that you had with employees or clients, whatever it might be. And oftentimes you look at somebody who's making $1 million and they are paying taxes on 50,000. Somebody who's making $1 million is making 80,000 a month. They're not looking for a house that they could qualify on 50,000 income. It's baffling to them. They're like, what in the world? So you have two choices. You either go back to your CPA and for the next 2 years, pay Uncle Sam whatever it is that you need to pay to be able to qualify for the house you're looking for. So if you really need to be making that $1 million because the house you're looking for is so expensive that it requires that kind of income, you're going to be paying $200,000 for the next 2 years. You're going to submit the taxes back to me. I'm on average 2 years at $1 million per year, 80-some thousand per month. That's my qualifying income. And we go from there. Most people miss that boat. Most people only realize what they've paid or didn't pay or what they're claiming when they are literally in front of a loan officer, because I will ask 50 people who are self-employed, how much money did you make? They'll say, I made 300K. How much did you pay taxes on? Pretty much so out of that 300, maybe 4 people would know. The rest will be like, I have no idea. My CPA wrote off all the expenses, right? Mm-hmm. So that person then cannot qualify for regular loan because effectively you can't tell Uncle Sam, I don't make any money, but then try to qualify for a loan that's more than your income.
Right.
So that's where we then do alternative documentation of income, where we look at different avenues of trying to prove how much money you make. But that then comes with a price because we are no longer in the realm of a traditional loan, meaning it's still a conventional loan, but no insurance company is going to now insure it because you're not proving income the traditional way, which is what you pay taxes on. So there is a whole slew of products, things like bank statement loans, which is when we take someone who's self-employed and look at their deposits into the business account and make those deposits become their income. Now, there's more complicated information that goes with it that I don't want to overwhelm everyone in, but essentially, depending the kind of business they have, there's a deduction of that income, and I'll make it sort of easy and quick. Let's say I'm a construction worker and I bring in $15,000 every single month. Construction industry has so much of upfront cost that the construction person tends to have to spend to keep their business going, that we're only able to utilize, generally speaking, 50% of that 15,000 as our income. While other industries don't have that heavy expense, so for them it may be only 20%. So you want to kind of sort that out. But anytime you are self-employed and you don't claim enough income, you are automatically going to have to be looking at what we call a non-QM loan, non-qualifying mortgage loan, where something other than your tax returns are going to have to validate your income. Remember, I talked about 3 pillars. The pillars in the mortgage industry is your money, your credit, and your job. So we have this job that we kind of are sort of straddling the fence on, right? Because we don't have a tax return that says I'm consistently making enough to pay this mortgage. Income that we can't prove. So the mortgage industry then has to replace these pillars with something else. So it's going to require now a higher credit score than it normally would, and a larger down payment, because a risk has to be mitigated in some sense for that lender to feel comfortable. So generally speaking, if you can't use your W-2 income, your tax return income, you are going to be looking at least a 680 credit score, at least 15% down payment.
Your
All
camera
those
went
things.
out.
I'm sorry?
Your camera went out.
Oop, hold on. I probably hit something. Hold on. Let me get my mouse. There we go. I'm back.
There you go.
Okay.
Yeah.
No, it's okay. I probably just swung my hand. I have multiple monitors. So depending on the specifics of that borrower, you then have to kind of figure out what's the cheapest deal. Now, the thing that is always the pushback from a buyer is the interest rate on these loans. The interest rate on these loans are going to be drastically different. But I thought about this today, knowing that we were going to have this podcast, because people hate math. And my joke always has been, if you want to really just take anything from anyone, it requires two things: put it in writing and have them do math. No one will do either one, and you walk away with their kids, the left kidney, and the car, and they still owe you money.
Exactly.
So the first thing that people always say to me is, Yvonne, the rate is 8%. You got to be joking me, right? I'm like, true. That's a lot of money, right? Mm-hmm. So let's use our example of $400,000 house. Somebody's buying a $400,000 house. Nothing unreasonable, nothing crazy. The normal rate is, let's just say 6%, but you got to have the 2 years of tax returns. So somebody say, I want to do that. I'm going to do that. I'm going to pay taxes for the next 2 years. So let's just say, back to our $120,000 borrower, right? I'm going to say, in order to use that entire $120,000, they're going to have to pay the entire tax without any write-off. And that's probably around 20%. Mm-hmm. I think that's a probably fair assessment. So that's $25,000 for 2 years. So we just gave Uncle Sam $50K. This $400,000 house, many of you guys are realtors, in those 2 years is probably now selling for $420,000. God forbid you did this before COVID. That sucker's selling for $550,000. So you missed out on 20%, $20,000 of equity. So now you're buying this house 2 years later at $420,000. You just paid Uncle Sam $50K in taxes. Why would you have not done that before and put that $50,000 as a down payment? Yes, you're getting the 6% interest rate, but the monthly payment between a $420,000 house at 6% versus $400,000 house that you would have bought now 2 years before, kind of the future, at 8%, it's about $300. $300 times 12 is $3,600. You paid $50K to Uncle Sam. That's a lot of years of living in that house to recoup that money.
Right.
But the math scares people because they see 8% interest rate and they're like, no. And 15% down, Yvonne, no, I can't do that. I'm gonna do the taxes. And then we do this math. And then I said, but you're gonna pay taxes. Your deductions, as long as they're legit, you should take them, right? This is sort of what America's about, entrepreneurship. But if you choose to pay that $50K in taxes, now all of a sudden your down payment, rather than having bought a house for $400,000, put $50K down, have a $350 mortgage. Now you're buying a house for $420 because it's more expensive. You wasted $50K to the IRS. I hope the IRS is not listening. I'm sorry, IRS, if you're listening. I'm up to date on taxes as far as I know. But that's an issue that a lot of people just kind of are. They hear the 8% interest rate, the down payment, and they kind of mentally walk away. Versus no. Do it the other way around, because the math always works in your favor. When you use the money for your down payment to your house, I'm always taken aback whenever people are pushing back who have the means to not put a down payment on the house if it truly allows them to get in the house. I always say we're not throwing it in the gutter. It's
Right.
literally paying down your mortgage.
Mm-hmm.
You will get that back when you sell that house. It's not like it's going poof somewhere. But if you're doing it to the IRS, it is going poof somewhere. They're going to repaint the reflecting pool again with it, maybe. I don't know. You know, I mean, it's really
Yeah.
not wisely used at the moment.
Right.
So I encourage people to really just think of the math and say, what's more important to me? Because I have never spoken to someone who's been in this profession who said, if you could teleport me back a couple of years, would you buy real estate? They're like, heck yeah. When the neighborhood wasn't popping and I could buy a house for 350 versus 450, gosh, I could make a profit on this. There's nothing like real estate. You can make $500,000 in profit without any taxes. Capital gains on selling a house that you've lived in have zero taxes up to $500,000. I don't know of anything else that does.
Mm. Awesome. Awesome. So I just want to we're getting close to the hour. So I do want to kind of ask a question from you. If somebody said that they're ready today, I mean, that they want to purchase a home, what should they do for the next, do and not do for the next 6 months to a year to prepare?
I think the thing that none of the like real homeowners really ever talk about, because I think we all kind of are a little embarrassed about it, but make some cuts where you can make cuts. Myself included, will go and spend extra $20 at Target for something I couldn't even pinpoint. You know, you look at your receipt, you're like, how was it $70, right? When you're purchasing a house, really make a conscious effort of saying, I'm going to invest in me.
Mm-hmm.
And every penny counts. Sometimes it's just taking lunch from home. If you eat out, lunch, Chick-fil-A, Panera every day, you are spending usually 15 to $20 a day on food. That equals to $100 a week to $5,200 a year.
Mm-hmm.
And most people don't do that math. So I would say do that first. Put yourself first and say, where can I make some cuts that are going to add, if not to my down payment, you might or may already have that, but to my physical reserves, financial well-being, stability, whatever it is that makes you feel good about going to a house that ultimately the expenses are yours. The second thing that I would also tell people is don't be afraid to talk to somebody about your credit and really take their advice to heart.
Mm-hmm.
Don't look for a quick fix, because usually what credit in a nutshell is this: a computer system is looking for a pattern, and it sees a pattern of someone who is high on their balances on credit cards or missing payments, whatever it is. And it keeps your score at a certain level because it says, hey, whatever's happening in your life, either you are irresponsible, you might have a family member that's sick, maybe your job is unstable, whatever it is, you are unable to maintain this financial situation.
Mm-hmm.
And then when you change that pattern, when you start paying on time, it essentially says, for lack of a better word, as a machine, Yvonne is doing something different. There's stability in her life, and it immediately increases that score. Third, I would look to see what your spending limits are on your credit card and how much of a balance are you carrying against those limits. Sometimes it makes sense to take those crappy Capital One's credit cards that you got when you were 20 years old at 18% interest rate, close them and open up a Visa that has a higher spending balance. So your $500 that you're carrying per month, it's not penalizing you because it's not at your limit. Because the Capital Ones of the world tend to give very low limits. So you go to Publix and to QT and you are sitting now at 80%, just one trip to each establishment. That's unrealistic and that's unreasonable. None of us are going to the ATM and getting a wad of money for the week. Like no one is.
Right.
You know, it like unless you buy something on Marketplace and the person's like, I only take cash. That's the only time I go to the ATM. So know why your credit is the way it is, and have someone who's not trying to give you a quick fix, but who is genuinely able to say, these are the things that are moving your credit in whatever direction, change those things, because that's all it is. Credit is pattern.
Absolutely.
So I would work on saving and credit. Those are the two things. Savings becomes overwhelming. Just look at little things. Just say, you know what? I'm not going to go and get coffee in the morning. I'm going to now do coffee from home. Whatever it is, just little changes that add up create success for all of us. It's sort of like, I'll go back to losing weight. The minute you lose 2 pounds, you kind of go like, gosh, what I'm doing works. It's working, right? But until you lose those 2 pounds, it feels like, this is really challenging. And I'm waking up every day and I'm walking with a weighted vest and nothing is happening. But the minute there's success, you are setting your alarm to walk every morning. I think it works the same way with credit. I always remember when people move their credit up and they will call me, they're like, Yvonne, my credit went up 80 points. I'm like, I told you. Credit just does its thing. It sees a pattern change. And to them, it's mind blowing.
Yeah. I am learning much more every day about what people can do, what I can do, and you hit the nail on the head, because most of us are impulsively buying coffee every morning and buying lunch, and those things really do add up. And if you really sit down and put an actual budget together, you see how much money you're just throwing away. So I think that is very important for everyone, whether you're buying a house or not, to review that. And I thank you for those suggestions for people. I want to thank you for joining, for answering all the questions. I really appreciate it. I just learned more. So I hope that my audience also learned valuable information. And I want to thank everybody who attended. Miss Yvonne, thank you, thank you, thank you, thank you, thank you. Hopefully you will come back again and speak with us.
Yeah, are there any questions for anybody else? Just
yeah, anybody have any questions?
No, this was a great, I mean, informative. I appreciated it.
Yes.
I'm a straight shooter.
I agree.
I'm a straight shooter.
Yeah. I enjoy you, Yvonne. It's probably the second time I've heard you speak.
Thank you.
And, you know, I'm a veteran. I'm a vet at this, but I learned something new about the VA, but you're very informative. Like, I love it. I love it.
Thank you. I think, you know, one of the things, honestly, like when going back to April's question initially, like sort of, you know, when somebody recommends a loan officer, I'm always baffled whenever somebody comes to me and they said, you know, I'm thinking of switching. I had this loan with somebody and it fell apart on, you know, 3 days before closing. And I'm like, why would you ever consider sending your business to someone who doesn't work harder than you at your business?
Yeah.
Like, I don't send loans to a lender that gives me like, you know, just a trash back. That would be the way. If I submit a loan, I expect that underwriter to read what I have sent to them, to follow all the notes. If they don't, and they just send me back a bunch of questions, I sometimes pick up the phone. I'm like, did you see all the things that I documented? Like, I'm not going to send you loans again because you're not doing me any favors. And obviously, we all are a reflection of each other to the customer. So if I do a great job, but the attorney does a horrible job, to that buyer, it was a horrible transaction, right? Mm-hmm. Because one person in this team just fell short of their expectation.
Yeah. Awesome. Well, if there aren't any more questions, again, I want to thank you, Yvonne, and I thank each of you for joining. Join me every Wednesday. I will have special guests. Hopefully, Yvonne will come back as well.
Of course.
But make sure you guys tune in. I really appreciate all of you.
You're welcome.
Have a good evening, everybody.
All right, you guys have a
You're
good
welcome.
evening.
Thank
Bye-bye.
you. Good evening.